Welcome back to the channel, everyone. Today I want to talk about Ken Griffin losing millions of dollars. I also want to talk a little bit more about what caused yesterday's after hours run and how everything is all interlinked. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, The Telegraph recently posted an article titled "Hedge Fund King Ken Griffin Loses Millions on a British Airways Bet." One of the world's wealthiest hedge fund managers has lost millions of pounds, so even more than millions of pounds when you convert it to dollars, after shares in the owner of British Airways took off. Ken Griffin, a Chicago-based financier worth more than $21 billion, or £15.6 billion, placed a multi-million pound bet against IAG just hours before new data revealed the Omicron variant had not dented airline bookings. His firm, Citadel, opened a 0.93% short position, a bet of around £70 million or $100 million against the British Airways owner on January 3rd. Now, obviously, those filings don't expose whether it's a short position, they just know that it's a put position, and therefore Citadel opened a short-term put position against IAG. Another of his funds had already placed a bet of 0.73% against the FTSE 100 group that also owns Iberia and Aer Lingus. So that's a total short-term put option of around 167 million US dollars against IAG and other airlines. A day later, IAG shares jumped by more than 11%. The stock is trading at 160 pence, valuing the company at almost $8 billion. And therefore, Citadel would have lost pretty much their entire put position, as it was likely a short-term put. Citadel was also not the only hedge fund to be hit by renewed optimism about fortunes of the airline sector. London-based Sandbar Asset Management amassed a bet of £110 million against the London-listed IAG, EasyJet and Wizz Air on December 30th. So it seems like Citadel and other funds are still trying to bet against the US economy and also the UK economy, and now Ken Griffin has been losing millions of pounds and hundreds of millions of dollars. Now this kind of links in to the after hours run that we saw yesterday in GameStop and AMC. Let me explain a little bit more. Moomoo's brand new promotion gives you a free share of AMC on top of the standard 5 free shares valued up to $3,500 each. I really like Moomoo because they don't make their money from payment for order flow. They make their money from margin interest and payment fees, and that way you don't have to worry about your trades going to sketchy dark pools or being given to Citadel. When you sign up with Moomoo and open your account, you get your first free share. When you make your first deposit, you get your second free share. If it's over $100, you also get that free share of AMC, and if you can deposit the $2,000, then you get all 5 free shares. So that's potentially up to $17,500 and a free share of AMC just for opening your account and making your first deposit using the link in the description below. Okay, so here's what's happening. The news that came out was not from GameStop. It was an article released by the Wall Street Journal. They did this to justify the after hours run up for the GameStop stock. In reality, banks were just covering some of their failed to delivers. Now we know that this article didn't cause the run up. You can see from the price chart that the run-up in GameStop and AMC started at $16.27 or $4.27, but the Wall Street Journal didn't post their article until $4.37, a whole 10 minutes later. GameStop and AMC had pretty much already experienced the entire after-hours run-up before the Wall Street Journal had even posted this article. And therefore, it clearly wasn't the article about GameStop's NFT marketplace that caused this after-hours run-up. It must have been something else, like banks and hedge funds covering a small portion of their failed to delivers. Now, I think in reality, obviously we have tons and tons and tons of synthetic shares, potentially billions of synthetic shares, and we also have hundreds of millions of failed to delivers that are being hidden and being rolled every single month or every single quarter. Now, I think this after hours jump of over 30% in GameStop and over 15% in AMC was those hedge funds covering only a small portion of those failed to delivers. I think if they actually covered all of them, we would have seen an even bigger run up, potentially to all-time highs and if not even higher. Banks were just covering those failed to delivers and grabbing some liquidity. But why would they need to grab some liquidity? I'll touch on that obviously after I've finished reading the rest of this paragraph. It says they had to justify GameStop's after hours run up, so they threw the article out there. The article was not an announcement from GameStop, and GameStop will make an official announcement when they are finished with the level 2. GameStop obviously won't make an official announcement until they are ready and everything is perfect. Now, we also know that we're nearing the end game because these banks, institutions and short hedge funds are also selling crypto to grab liquidity as well. If we have a look at the Bitcoin price chart over the last month, we can see that Bitcoin fell from around $52,000 down to around $46,000, and then again fell to around $43,000, and now all the way to around $41,000. We can also see the 24-hour volume has increased from around $20 billion all the way up to highs of around $65 billion. So why are banks selling off so much crypto? And again, it's to grab more liquidity. Obviously, they can't use crypto to meet these margin calls because crypto isn't a AAA rated asset. So they're having to sell off their crypto to pull out cash to meet those margin calls. Now, so why are banks and institutions covering these failed to delivers to get cash out and also selling off crypto to get more cash out to meet these margin calls? Where are the margin calls coming from? Well, Unusual Whales tweeted saying Bloomberg notes that this is the highest or largest tech sell-off by hedge funds in over 10 years. Right now you can see tons and tons of large tech companies like Etsy, for example, which have fallen from highs of around $300 per share down to around only $200 per share, like a 33% drop all the way up to 50% and even higher. Yes, some of the large tech companies like Apple haven't fallen too severely, but there's tons and tons of large tech companies that right now are down over 50%. And therefore there's tons and tons of hedge funds that are now down over 50% of their investment on these large tech stocks, meaning they're losing massive amounts of margin capital, meaning that because they've already maxed out their margin borrowing, they're struggling to meet margin calls. Obviously, we know that if these massive institutions fail those margin calls, they will be liquidated and they will be forced to cover their AMC and GameStop shorts and all of those synthetic shares. Now, to link everything in even more, it is very possible with all of the weird malarkey going on right now and the massive amount of options expiring on the 21st of January 2022 that a rerun of January 2021 could happen. But importantly, last time mistakes were made. Let's rehash a few major points as to not make those mistakes again. Number 1, take care of your margin. When hedgies started collapsing the price, a lot of you had your positions closed out right from underneath you due to sudden margin calls that gave little time to react. Make sure your positions have not been bought with borrowed money. Deposit whatever you need right now. Yes, it will be tempting when AMC and GameStop start running up to buy even more shares and to borrow money on margin to buy even more. But you have to remember that when AMC and GameStop do start to squeeze, it is going to be very volatile. The price will go up, but the price will also go down very quickly as well. And therefore, if you're borrowing too much and not watching your margin, you could get margin called. And obviously the problem is if you get margin called holding a large AMC and GameStop position, they will sell your shares, and that obviously will harm the squeeze if tons and tons of margin calls are happening. He also says remove stop losses. Again, because AMC and GameStop are going to be so volatile when they squeeze, you could easily get stopped out on your position, and again, that's obviously going to sell your shares. He also says to get out of Robinhood. Obviously that doesn't need much explanation because Robinhood turned off the buy button, and that's why I'd really encourage you to sign up to Moomoo using the link in the description below if you haven't already, because they don't make their money from payment for order flow. They make their money from margin interest and from payment fees. He says if brokers kill the buy button again, do not sell. He said a lot of people who FOMO'd during the run-up probably had no idea about the plans Ryan Cohen had for GameStop or who Ryan Cohen even was, and simply thought everything was just a huge pump and dump. But obviously we've seen AMC and GameStop run up in January, we've seen meme stocks again run up in June as well, and therefore we know that when it happens for a third time, we could potentially start the squeeze. And he also says to DRS. Now again, I also think this is a good idea because it means your shares will be in your name and not in the street name, and therefore your shares can't be lent and used to short even more shares of AMC and GameStop. We know that the squeeze is going to last multiple days, if not more than a week or two, and therefore you don't really have to worry about computer share taking 30 minutes to an hour to sell off your shares. Now, you may have also seen that Adam Aron has just introduced vegetable tenders to come next week to all AMC theatres. Now, as 8 from Sack says, this is synthetic tendies confirmed. Vegetable tenders aren't real tenders and therefore they must be synthetic. So just another way for Adam Aron to confirm the existence of all of those synthetic shares. And finally, Cineplex seems to be laying off 5,000 part-time workers for the short term while cinemas are closed in Canada. Now this is very, very interesting because AMC has just posted some new job offers in Canada as well, and therefore it could be that AMC are planning a takeover of Cineplex. Clearly Cineplex are short on cash if they're having to lay off over 5,000 workers, and therefore this could be the perfect time for AMC to swoop in and make a large acquisition. This is Canada's #1 movie theatre chain, Cineplex, has pink-slipped close to 5,000 part-time workers given Ontario's recent decision to close cinemas amongst the Omicron surge. I think this could potentially be the perfect timing for Adam Aron to make an acquisition, and it would be a brilliant catalyst for tons and tons of large institutions to buy more AMC shares. And obviously if they do buy more AMC, it's only going to help us and make the AMC stock more volatile over the next few weeks. Guys, be sure to let me know down in the comments below what you think about Ken Griffin losing hundreds of millions of dollars. And if you want to stay up to date with all of my latest stock and crypto picks, or if you just want some help with AMC and GameStop, be sure to check out the Patreon and the private Discord, linked in the description below. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.